I'm doing a series of 4 videos. The first video, this one, will discuss the difference between double entry accounting and triple entry accounting. The second video will cover how the largest grocers in the world are migrating their supply chains over to a blockchain. The third video will cover how this migration of grocers' supply chain over to a blockchain will ultimately result in mass business-to-business adoption of cryptocurrency. It is really important to note that no cryptocurrency is used for payment within these existing platforms today. The fourth video will cover how we can prepare for that mass adoption from an accounting perspective. So I first got involved in cryptocurrency and blockchain back in the summer of 2016. I basically fell into that rabbit hole they speak of, and I still haven't come up for air. Now, what fascinated me about Bitcoin was the underlying technology called blockchain and ultimately its impact on accounting. Now, when there is widespread adoption of cryptocurrency and blockchain technology in the future, the impact on accounting, it just can't be overstated. To explain how this tech will basically revolutionize accounting, we just need to look at how the underlying transfers of value on a blockchain will be accounted for. So, today and for the last 500 plus years, we use double entry accounting to reconcile a business's books and records. Blockchain technology will allow for something called triple entry accounting to become our new standard. So let's just walk through an example of the accounting for an exchange of value today within the traditional payment rails using double entry accounting. And we will record and reconcile the transaction. So I'm going to send you $5,000 for consulting. On my ledger, I'm going to credit my cash for $5,000 and debit consulting expense for $5,000. Now on your ledger, you're going to debit your cash for $5,000 and credit consulting income for $5,000. Then, once the transaction clears my financial institution, I can reconcile my cash account. And once that transaction clears your financial institution, you can reconcile your cash account. Now at that point, my books are reconciled and your books are reconciled. Now, if we were to transact on a blockchain instead of the existing payment infrastructure, right, the transaction would be accounted for quite differently. So let's take the same example as just described, and then let's use a blockchain payment infrastructure instead. So again, I pay you $5,000 for consulting, but this time we do not have our own ledgers to maintain. Instead, we share a ledger. The first entry on the shared ledger is that I get a credit for $5,000. The second entry is that you get a debit for $5,000. And then the third entry, the triple entry, is a cryptographic timestamp on a blockchain. The result is that you and I both don't need to reconcile our transactions with our financial institutions because there was no financial institution involved in that transaction. Instead, it was a peer-to-peer transaction, meaning that I transferred value to you with no third party bank involved. Plus, and the most important to me at least, the transaction we just entered into, it was reconciled in real time on our shared ledger as soon as that third entry occurred. Let that sink in and see you guys in the next video.